I have watched intelligent people stay poor for one reason. They never build a simple investing system. They bounce between fear and excitement, and they keep resetting to zero. A system protects you from your worst day. This guide is about building that system from the ground up. Most mistakes come from impatience, not from lack of intelligence. Let me start with why you should invest in the stock market. To start, the S&P 500, which stands for Standard & Poor's, is a stock market index that tracks the top 500 U.S. companies. This is one of the most followed indexes, and it is considered to be the best representation of the U.S. stock market. The best thing or fact that you should know about the S&P 500 is that it has been consistently trending upward and producing an average annualized return of around 8 to 10% per year since it got started. At the top of the list is stocks with 5.2%. You can see that stocks has the highest average annual return compared to other investments like treasury bonds. Fine art and other commodities like precious metals, like gold, real estate, for example, even comes in at number 10 at 0.3% over the long-term stocks, have the most potential to transform your life because your typical big bank like Chase or Wells Fargo will offer you an interest rate of 0.1%, maybe 0.15% in your savings account. Let me pretend for a next that someone hypothetically gave you $1 million and you wanted to live off of that money for the rest of your life. If you were to put it all into a Chase savings account that, say, paid you 0.01% on your money, you would only earn $100 in 1 year. In my world, compounding is the quiet engine that does most of the work if you give it time. Now that completely changes things, right? Like you can live off $100,000 per year. That sounds pretty nice to me. And even at 5%, that would get you $50,000. Per year with $1 million balance, the thing about investing is that our money will work for us and compound over time. And the term compound interest refers to the interest that you earn on your interest. And this can be illustrated by the following example. Say you invest $1,000 and you get a 10% return in a year. By the end of year one, you are going to have $1,100 in year two. You'll get the 10% gain again. And now you are going to have $1,210 because you are getting 10% on the now bigger $27 by the end of it. So just by putting $1,000 in and getting a return every single year, you can see that your money starts to compound and grow even bigger upon itself. And the fourth reason I think you should invest into the stock market is simply because of inflation. The U.S. has a central bank called the Federal Reserve, which dictates the monetary policy of the entire country. They've said publicly that they target a 2% inflation rate per year to keep the economy healthy. But as of recent years, you might have noticed that in the news you might have seen inflation closer to 5 to 8% during the years immediately following the pandemic. That means if our money isn't outpacing inflation, let me say inflation is 5%, and if we are not earning at least 5% on our money, then our money is losing purchasing power just by sitting in that account. This is best illustrated with the example of the U.S. postage stamp. So in 1971, the postage stamp cost 8 cents to mail a letter. As of this year, it is 73 cents. The mechanics of the postage stamp are exactly the same. The stamp just gets you a letter. Let me pretend you earn $70,000 US a year. That is about the median household salary in the United States. That means after taxes, you'll have right around $500 to $5,000 per month. So that is what you do. You put an initial deposit of $5,000 in there, and you are going to be adding about $1,000 per month every single month. The average annual return that we are going to put in is 8%. And the years to grow will toggle this to 30 years. And I want you to see the power of the compound interest that is working here. In 30 years, your portfolio balance will be over $1.5 million. And your total investment over time has been $365,000. While your profit is over $1.18 million, there are two factors at play here. One is that you are consistently investing your money into the markets, and the next is that you are leveraging the power of compound interest and time. Let me say you were able to invest $2,000 a month this time and you got the same return. Look at how much more powerful this is. A $3 million ending balance, and you can see that most of the gains are towards the end. The key to investing then, in my opinion, is continually investing and trusting the process. From here, a quick note on how reliable the stock market is. Of course, you can lose money in the market. Some years are going to be down years. In 2022, for example, the S&P 500 was down close to 18%, and then sometimes in other years you are going to be massively positive, like in 2024. The S&P 500 was up 25%. And in 2023, I think it was up around 20% as well. He states that over any 20-year period, U.S. stocks have had no real negative returns when including dividends, and over a 30-year period, the returns have generally converged despite some dispersion. So that basically tells us that to accumulate our wealth in an aggressive manner, you should just keep buying no matter what. What investors believed at that time, they believed that the market was overpriced by 50% in some cases. But look at this graph from the S&P 500. In 2012, it was trading at 1,400, and today it is trading at close to 6,000, if not already over that. So now that we've covered that, let me actually go over what is the stock market and what is a stock. So basically, the stock market is just a marketplace that is now all digital. And in this marketplace, people are buying and selling stocks left and right. When you buy a stock, you are purchasing a small piece of ownership in a company, and you are typically buying it from someone that is selling it to you on the open market. Owning a company's stock gives you claim on its assets and earnings, and the stock market allows you as an individual to trade these shares, and the prices of these shares will fluctuate. Now, to quickly explain why companies would even want to sell their shares on the open market. The reason is that companies sell their shares on the open market primarily to raise money for growth and expansion. They like to raise capital. And this process is called an IPO, or initial public offering, giving a larger pool of investors access to that company's shares, including you and me, and therefore you can speculate on the price and perhaps the future direction of the company. Now, being bearish, on the other hand, or a bear as they like to call it, means that you have a negative outlook on the market, and you expect prices to fall. The easiest way to remember the difference between the bull versus the bears is that bulls typically have horns and the horns point upwards, and that is the direction you want prices to go if you are someone who classifies themselves as a bull. The next important term you should know is market cap, or market capitalization. This just refers to the size of the company you are talking about. So if a company has a large market cap, that means the company itself is very valuable and worth a lot in terms of valuation. The next term you should know is an index. We've already covered this a little bit, but an index tracks the performance of a group of pre-selected investments such as stocks. So in the stock market, we have the S&P 500 index, the NASDAQ index, and the Dow Jones. So when someone says the market is frothy, they mean that the prices of the stocks and valuations are being inflated to a point where it is kind of bubbling up to the top. Just like if you had a really bubbly drink, the bubbles are exciting and they are slowly rising to the top, and you do not really want them to overflow out of that cup. The next term is blue chip stock. This means an excellent stock. Apple would be a blue chip stock. These days, Coca-Cola is a blue chip stock. McDonald's and Microsoft could count too. The origin of this term came from poker games back in the day when the blue poker chips were the most valuable. They're categorized in three different ways, either by market capitalization sectors or themes in terms of market cap. This helps you as an investor understand the size of the company and its risk profile. The way that it is calculated is by multiplying the company's share price times the number of shares that are in circulation. There are microcaps, which are companies valued at less. Now, microcap stocks are usually way more volatile, much riskier, can have a lot more upside because they're so small. They have tons of room to grow, but these are usually known as penny stocks. And as beginner investors, we are probably going to stay away from penny stocks because investing in penny stocks. That's why now let me actually talk about what to invest in as a new investor in the stock market, I think. There are a couple of approaches that we'll go over today. The first approach is simply investing in individual companies. This approach can be very exciting because of its potential for high returns, but it is also a lot riskier. For example, let me say you have $1,000 in your portfolio and you decide to invest $200 each. You may underperform the market in a more volatile year, and the name of the game with stocks and the stock market is that you do not want to underperform the market, because the market is the easiest benchmark to hit if you just invest. In index funds, you will hit that market return if you were to pick individual stocks. That is a tempting way to try to beat the market and build your wealth quickly, but it requires a lot of research, a lot of high conviction, and you just have to accept that you might lose money or your portfolio balance will be very volatile. The next approach, and the one that is much simpler and more beginner-friendly, is just simply investing in index funds. An index fund, like an S&P 500 ETF, gives you exposure to a diversified portfolio of hundreds of the top U.S. companies with one single purchase. This is more of a passive strategy where you basically set it and forget it, relying on the market's historical average returns of 8 to 10% over time. An example of a fund that tracks the S&P 500 is ticker symbol VFIX, or ticker symbol. VU is the ETF version. A ticker symbol is like an airport code. You know how JFK references John F. Kennedy Airport, or LHR, is London Heathrow Investments, that you can buy in the market have their own codes, and these are called ticker symbols. This is why companies like Apple, Google, Microsoft, etc., they have their own symbols. Index funds are passively managed. This is why there are super low fees, because they have no fund manager, and not to mention your money is being instantly diversified among all these holdings because adjusts its asset allocation as you approach retirement. For example, if you plan to retire in, say, 2060, a target date fund will start heavily weighted in stocks right now and gradually shift towards safer investments like bonds as the retirement date approaches 2060 refers to the date that you would want to retire. And these are most commonly found in retirement accounts like the 401k for most beginners. I think you either go with all pull up that to this day, you would still not have broken through its all-time highs. Back in 2000, compare that to the overall performance of the market since 2000, which has 4 to 5x since then. This is the danger of picking individual stocks. So whenever you are buying a stock, you need a special account to buy it in. You just cannot buy it in your bank account. You need something called a brokerage account or a retirement account like the IRA, the Roth IRA, or the 401k. Once you have one of these accounts, you can then transact your stock or your index fund purchases. The most common type of an account is a brokerage account. Now within these brokerage websites, you can open up what is called a taxable brokerage account. That is the standard brokerage account that most people will use to buy and sell stocks in. You can also open up a retirement account like the individual retirement account known as the IRA or the Roth version of it. Like the Roth IRA, the 401 plan is something you need to set up with an employer. Now my favorite account to trade in is the Roth IRA. If there is one takeaway you remember from this guide out of everything, it is to start a Roth IRA because the benefits are incredible. This is an individual retirement account where you put in after-tax dollars, but as a result, when you invest within this account, all your earnings are tax-free. The contribution limit on it is about $7,000 per year as of 2025. That could change in the future. It might go up to $7,500, but right now it is $7,000. Now here is the power of that account. Let me say you have Apple stock in a Roth IRA and you buy Apple stock regularly. Let me pretend in 50 years I do not know. You make about $2 million from it. You wouldn't owe any taxes on those gains, versus in a normal brokerage account you might owe 15 to 20% in taxes on those gains. In a normal brokerage account, gains are taxed, and we'll talk more about taxes later, but in a Roth IRA it is completely tax-free. And that is why it is so powerful for now. You just have to know we need a special account to actually trade in, and you'll either set up a Roth IRA or a taxable brokerage accounts, and then you will trade stocks in them. So let me talk about researching stocks from here because it is a very important part of this guide. There are two camps that investors usually fall under. There is fundamental analysis, and by comparing the intrinsic value they calculate to the current market price, they can then decide whether or not a stock is undervalued, overvalued, or fairly priced. Let me talk about the 5 indicators that you might want to look at the top of the list. And 2 are revenue and net income. So revenue simply shows you how much the company is bringing in terms of total sales. Net income is the profit or the amount that called the price to earnings ratio. And I have actually talked a little bit about this in this guide already. Many investors use this P/E ratio to gauge the current valuation of a stock. One of the ways we use P/E ratios is being able to figure out how much we are paying for a given company. If a company's P/E ratio is 20, this means that investors are currently paying $20 for every $1 of that company's earnings or profit in general. For example, companies in the technology sector typically have a higher growth rate compared to those in the retail sector. Therefore, P/E ratios for tech companies will be higher overall. And as with everything, context is highly important, and this ratio should be only used as a comparative tool when comparing companies within the same sector. There are general benchmarks for what a healthy P/E ratio looks like, depending on the sector or industry that you are trading in, and usually that varies a little bit, but you can. For every $1 of profit that Apple produces, a higher P/E ratio, such as 38, often suggests that investors expect strong future growth or view the company as. So now let me talk about creating a portfolio. When it comes to creating a portfolio, there are first a few questions that you need to ask yourself. First is to figure out your investing style to understand what type of holdings that will fit you within your portfolio. Chances are you probably inherently know if you are more on the riskier side or more conservative side, and if you do not, there are questionnaires online that you can fill out too. Figure out what your investing personality is like, and I will link one below right now. You can see a spectrum of risk to reward ratio. And at the very bottom we have savings accounts. This is just liquid cash sitting in. Hopefully a high-yield savings account, and it gives you a lot of flexibility because you have access to it right away. If you are someone who is super risk averse, pretty comfortable with any ups and downs in the market because your time horizon is long. However, if you can only invest for a few years to say maybe because you want to put a down payment on a house and you are it then, well, you do not have your down payment. It is important to understand why you are investing because it is going to guide a lot of your investment decisions, and it may actually save you from being too emotional if the market performs with a lot of volatility. I have spent a lot of time studying the best ways to build wealth through investing, and one of the simplest and most effective strategies for new investors is something called the 3-fund portfolio. It is a great approach that is set it and forget it. And this is where you buy 3 ETFs, one covering the US stock index, one covering the international stock index, and lastly you have an ETF of bonds. This gives you a diversified low-cost portfolio that can weather almost any market condition. And my personal 3-fund portfolio will. Now the entire premise of the 3-fund portfolio is that since even professional active money managers have a hard time beating the market, the average investor would just fare way better if investments split among the 3 funds. There is many different approaches. My personal one is 60% US stocks, 30% international, then 10% bonds, but it is going to depend on a lot of factors. I have a full walkthrough on the 3-fund portfolio, and I will leave a link as well. If you do not want to do ETFs or index funds and would prefer the individual stock method, you can do that too. I would just say that with individual stocks, you need to be a lot more purposeful in the ones you do choose. And if you are choosing a basket of, now let me actually go ahead and just buy Coca-Cola after you click buy, you are going to get a screen like this. This is the order screen. And you can see that the last price of Coca-Cola was $62.71. Next up, you have market versus limit. So these are order types, and this is a little bit complicated for a beginner. But essentially what market means is that whenever the market is open next, your share will execute as quickly as possible at whatever the market price is. The other option is called limit. And that is where you can specify you buy fractional shares. So if you put in $50 right here, you can see that the estimated number of shares that you get is 0.797. This is a fractional share that not many other brokerages might offer. That's why let me actually type in symbol VU at the top here. And that is the Vanguard 500 S&P Index Fund ETF. You can see that the last price was $549.46. And if we only bought $50 worth, it is 0.09 worth of a share of VU. But let me just do it for fun anyways, and we'll click preview order. So this is a good to know market and limit, buy and sell orders of stocks and ETFs in dollars are only allowed during normal market hours. Now let me talk about taxes on stocks, because this is going to be pretty important when you are making gains in the stock market. Whenever you make a gain in the stock market, you will owe taxes to the government. I know it sucks, but in the United States. Now please note, in order for you to actually pay taxes on the stocks, you actually have to realize the gain, which means that you would have to sold the stock that you made money on if you simply bought a stock and just held it indefinitely. You do not owe any taxes. It is only when you sell the stock and you actually make that gain. Then you pay the taxes. Now there are 2 tax treatments for stocks, either short-term or long-term capital gains. A short-term capital gain occurs when you hold the investment for less than 1 year and therefore is taxed at a higher rate. It is typically your ordinary income rate, which is the tax rate that is based on your incomes. So as an example, pretend you buy $1,000 worth of Apple stock in January, and then just say it doubles. That's why it goes up. It is great. And you sell it for $2,000 in June of the same year, since you didn't hold the stock for a full year. You will owe short-term capital gains taxes on the $1,000 in profit that you took if your ordinary income tax rate is 35%. So if you are able to sell a stock after holding it for a year, you will pay considerably less in taxes. The long-term capital gains rates are roughly half the rate of short-term capital gains rates. It is typically 15 or 20% depending on your income. There are also some cases where if you do not make that much money on a yearly basis, the long-term capital gains rate is actually 0%. But that is if you make less than $47,000 a year. So obviously there is a huge difference here, but I think the most important thing to note is that you shouldn't let taxes control how you buy and sell or invest. Some profit than not have any profit at all. If you are on day 364 and you have a massive gain and you want to get out of that position, then maybe I would tell you to wait until day 365 to sell that. Have at a loss in order to offset any gains that you might have incurred throughout the year. So new example. Let me say you take $10,000 in profit in the markets over the course of this year, but you have one pesky stock position. Let me assume it is GameStop, and it is down $4,000 this year. That $4,000 loss of GameStop, if realized, so if you sold it and you actually lost $4,000, you can offset the taxable gain of $10,000 by that corresponding amount. That way you reduce the amount of taxes you pay, because now your yearly taxable gain is now only listed at $6,000 total dollars. Now, one way to avoid taxes altogether when buying and selling stocks is by investing through a Roth IRA, which we already talked about earlier in this guide. If you do have further tax questions and you do not know how to answer them, make sure to consult with a CPA or tax attorney that can help you more than this guide can. All right, if this feels like a lot, take one step. Open the right account, automate a contribution, and start with a simple index fund. Then learn as you go. Doing beats dreaming every time.